the bottom one is the unemployment rate, a macro. And we've talked about this. It's like the business cycle, the setup that it's not going too good. The miners, they love economic turmoil. Maybe again, because of the oil prices going down in recessions, helping with whatever the margins, making the miners better fit. Look at the 70s, higher lows, higher highs for the miners and for unemployment rate. Loved it. Unemployment rate unwinds. Guess what happens to the miners? Unwinds. Look at that, the 2000s. Unemployment rate trends upwards. Get what happened to the miners? They trend upwards.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving deep into the dynamic world of precious metals, the miners, technical analysis, and the charts. I'm thrilled to introduce Patrick Karim, co-founder of Northstar Badcharts, a leading technical analysis and charting firm. With a unique background in systems engineering, commerce, and psychology, Patrick brings a methodical, evidence-based approach to navigating the complexities of trading, particularly in gold and silver. Patrick, it's an honor to have you back on Metals and Miners. Welcome to the show, my friend.
Thanks, Gary. I can't believe there. It's like you told me there. It's like last fall there we touched base there. It's just time flies by. It's just crazy.
It really does. But it's good to have you back, and I'm excited to jump in. So let's start here, Pat. Precious metals mining investors have been tossed between despair, euphoria, and they've generally been whipsawed all over the whims of the market over the last several years. Things seem to be moving in a much more stable place for the miners as the metal prices are stabilizing higher, energy prices have stabilized lower, and balance sheets are significantly improved compared to the years past, alongside even the macro setup. What will those tuning into our conversation today walk away with after listening to our discussion?
Well, okay, yeah. So my first piece of advice there, and this is going to probably help for the entirety of this podcast there. People have to decide what type of trader they are. Are they day traders? Are they long-term investors? Are they stackers? Do they just accumulate ounces of gold? They don't care about the price, because that's very important. With technical analysis, there's this concept called multi-time frame, and even in real life we have it, right? You have long-term plans with your family, then you have shorter-term tactical stuff you're going to do with your family, like a trip to Disneyland, but then you want to build a house, a family. So in trading, it's the same thing. What do you want to do with your investment? Is it a 5-year hold, a 2-year hold? So then you're going to start looking at the monthly charts, the quarterly charts, and then you get a whole bunch like a longer-term trend. And then on the short term, let's say we get a bull era for gold, silver, precious metals, but within that, as it extends too much, sometimes you'll get bearish cycles within that. And so that's why some people are confused. Patrick, I don't understand. You're saying gold, it's not time to enter, or it's turning downwards. Yeah, but sure, I'm talking about a shorter time frame. So step number one, always make sure that you can sync up your time frame with whatever the technical analysis guy is talking about, because while we don't always say it, we're geeks about TA. It's important to know that there is this notion that you could be bearish and bullish at the same time. It's complex, it's nuanced. It's not just Patrick, tell me, should I be in or out? Well, it depends. Again, like I said, what's your time frame? So I just want to put that out. It's important. I like to reiterate that, and just to help people better understand and extract value there for what we're going to say now. I'll stop talking. I'll share the charts, because people are going to say, Patrick, like, you're not sharing. I don't care. I don't care what you say, Pat.
Well, I appreciate you saying that. Let's move into the markets. Last week, Fed Chair Powell spoke to the public, and in his speech, he mentioned that conditions are such that rate cuts in the near future may be warranted. The markets responded very bullishly. What could you show us in the charts that happened, and what do you expect to happen if they follow through with the rate cuts?
All right. It's been a while there. Here I have the unemployment rate for the US, and here at the bottom I have the 2-year yield. And the Fed fund rates, they track pretty accurately the 36-week moving average of the 2-year yield. So whatever the market, the bond market players, they price the 2-year yields. If you smooth that out with a 36-week moving average, it looks pretty much like the Fed fund rate. You know what? Like, okay, I'll just show you guys real fast there. This is kind of important. So here I'll put the US zero. I'll put the 2-year yields. I'll put on the weekly, and then I'll overlay the Fed fund rate. Fed fund rate. And I'll put it same percentage scale right here. Okay, and then I'll put it regular. I'll remove the 12, remove that, and I'll remove the price. So here's the price. The candles is the 2-year yields, the actual price, and the red line is the 36-week moving average. I'm just going to hide that. I'm going to hide. So here I have the Fed fund rates. I'm going to zoom out. Okay. So the Fed fund rates, guys, is this line. I'll put it black. Maybe it'll be easier for you guys. So that's the Fed fund rates tracking the 36-week moving average of the 2-year yield. So it's pretty much like, who's the chicken and the egg? You know, is it the Fed fund? Is it really the Fed deciding what's going to happen to the market, or is the market already telling the Fed, look, we're pricing in the cuts. You might not want cuts. Maybe you have some ideas, but I'm forcing you. But at the end of the day, it doesn't matter who's the chicken and the egg. You could see that the 36-week moving average was already turning down for the 2-year yields. Fed fund rate followed suit after it dropped, reconnected it. And now look at the 36-week moving average for the Fed fund rate for the 2-year yields. They're already turning back down. So I'm expecting a reconnect here. I don't know. The Fed fund rates might drop. What are we here? 4.3, 4.25. It's going to drop there, and it's going to drop. And here you could see it here in the 2019 rate cutting cycle. Here you see in the GFC, the 2008. Here you see it in the 2001. So most of the time, the Fed fund rates, they exaggerate to the upside. They go a little too high. The market starts turning down the 2-year yields, and then they catch up, and then they drop fast because the 2-year yields are below that moving average, and they just track and reconnect over and over again. So we have a little gap here. So you could expect the Fed fund rates to go down. Why are they going down? Well, let me just click here. You have the unemployment rate going up. I've been noticing that for a while. And unfortunately, you know, you start getting bearish the economy when you start going it up, but sometimes you don't get always the recession. Here's a GFC one. You don't always get it at the beginning of the turn of unemployment rate. Sometimes it could be higher up. You need even more unemployment, but that's the setup. Unemployment rate low, going up. The 2-year yields topping out and turning down. And if the Fed cuts, then they're confirming what the market players, the bond market players are already pricing in, that's going to be cuts. And they're not cutting for the fun of it there. They're cutting because unemployment rates going up, a whole bunch of other economic macro indicators there. They're also starting to creep up. The 10 minus the 2-year yields.
You have a correlation with the other chart that you have with those two metrics on there and the actual markets. You know,
yes.
You do.
So each of these times that the unemployment rate goes up and there's a rate cutting cycle, the market takes a hit. Always. There's always, every single time there's a recession. My goodness, could I find that? Every time there's a recession, the market always takes a hit. What's the size of the hit is going to be? That's the question. If you're having a recession, but during a bull era for stocks, so the stocks in the 1980s all the way to 2000s were in a bull era. You got a recession in 1990. The markets went down, but nothing like the 2001. You know, it all depends when the recession happens. My goodness, if I could find something here. But there is always a market downturn when here's the GFC one, here's the 2001, and at the same time, at both those moments, the unemployment rate was starting to go up, the 10 minus 2 starting to go up, and you're in a rate cutting cycle. But this is the issue. If I could jump to the markets, where's my SPX chart? Where is it? I'll put the SPX chart right here. All this stuff, I'll put it up here for you. So over here, look, all this is not important. I could tell you about the unemployment rate. I could tell you about all the bearish stuff, but until the market actually starts faltering, there's no, like, does it matter for us traders? You know, like I could zoom in here on the 8-hour chart for SPX. I'll remove the drawings. Here's the 8-hour chart. So before the monthly chart starts turning down, well, the weekly chart has to turn down, and the daily has to chart to turn down. And before the daily chart turns down, this 8-hour candle chart has to turn down. And look, there's nothing yet so far. So you got to, I'm going to put an alert right there. If ever we close below 6,300, then I'm going to see, okay, how long does it stay below 33, this level here? It's going to bounce a little bit. If it starts going down like that over time, depending what happens, then I'll see the damage on the daily chart, on the weekly. Then that's something more important, because you have the smaller time frames, you have that small ripple that's starting to cascade on the higher time frame, dragging it down. But there's nothing, if I'm a bit objective and unbiased, even if there's a rate cutting cycle, and usually that's when the markets start turning down, until I start losing a rising trend line here on the shorter time frame. You know, by the time this releases, this podcast, maybe it will, you know, start turning down. But look, the higher time frame is up and away. And I'll show you another chart.
It sounds to me like you're expecting the rate cuts to track the 36-month 2-year trend. And but even though you are expecting the general markets to take a hit, the trend is still up. And so you're not seeing any evidence at this time that it is going to take a hit. So until that trend changes, the trend is up, and it will remain. So your expectations are it will continue to go up until that trend changes.
Yes.
Okay. Yeah.
Here's just before to close up this point there. Look, here is the SPX since 1919 there. And we've had a crazy run here from 1949 all the way to the late 60s, where it went sideways, multiple bear markets. Here, the bottom pane is gold versus SPX. And as the markets go sideways and recapture that longer term moving average, gold, silver, uranium, oil, insert your favorite commodities, they outperform the SPX. And that's what you want as an investor. You want to be in the asset that's outperforming the other one. Here you had a crazy bull run again for stocks, goes sideways, instigated by a setup similar to today, right? Unemployment rate going up in 2001, the 10 minus the 2 shooting up, rate cutting cycle, all that stuff. It's happening right here while the price is extended. So while the price is still going up, you got to say, like, there's a setup there for a fall. And look, here's gold versus SPX starting to turn up again. Gold, everything, commodities outperforming. And look where we are today. We've had a pretty impressive run, 2009 all the way here to 225. And look at gold versus SPX there. My goodness, it's not breaking downwards. It's actually carving out, which could be a nice bottom right here with a valid breakout line. So if ever the stock market breaks down, this is going to shoot upwards. And that's how often these instigating movements here, it's not because gold goes crazy upwards. It's because the market goes down, makes that ratio chart go up. It happened in 1969 or 70, it happened in 2000, 2001. And if it happens again, then I'm expecting the gold versus SPX chart to break out, confirming what we call a capital rotation event. I expect the stock markets to go sideways for 10 years, a couple of vicious bear markets in between 40, 50%, then a grind sideways down, 100% rally up, then down, and then eventually
you're just not sure the timing of the start of this, but that's what you're expecting, that environment to be coming our way here at some point soon.
There's so much evidence that it's closer than further away, especially here that you know that you've ridden for 10, how many years is that? 2009 to 225. It's 16 years. 16 years. The low risk entries for the stock market, 2010, 11, as it's breaking out here, not deep like this. The further you get away from that longer term moving average, the more you're vulnerable. So you don't front run it, because the perma bears, they're always front running it. They always see what we see, but they call it, it's going down, it's going down. No, but what I'm telling you guys is the setup, the backdrop if ever there's a market going to be rollover, with hindsight, so of course it rolled over. Look at all the indicators are telling you, but as a unbiased chart trader, you got to say, okay, the indicators are there, but until it materializes, the market could still go crazy, go up 20 to 15%. I don't know how, like.
Yeah, no, that makes perfect sense. All right. And I think everybody's, who's tuning in is hearing what you're saying. That's a good warning for everybody to understand. Yes, the indicators are there. Yes, all the metrics are pointing to that. But until you start to have complete confirmed evidence that that is what is taking place, you don't change your strategy until then. So yes, I think we're hearing that. Let's move over to gold here. Um, you've spent a lot of time with in-depth technical analysis on gold. Gold is a very important precious metal for those who are tuning in to Metals and Miners. What do gold has been, churning essentially sideways, but a little bit down since mid-April. It was really stretched from its 200-day moving average, I think. And it's closing that gap, but not completely yet. What do you see for gold? What are you expecting for gold?
Yeah, well, I like what you said there. It was distance from what the 200-day moving average, or it's very important to understand that the distance from moving average, it's like there's eventually a recapture. Here at the bottom pane, I have the distance from the 36-month moving average. So what is that? 3 years, right? And it is historically stretched from that moving average. And back in April, we spotted that. And we said, oh my goodness, look, from a statistical point of view, look, I don't want to, I'm sorry, guys, if you've seen this before, but it's very important. Most of the data points are below this dashed line there. So most of the time, the price of gold stays within this range, the distance from moving average. So that means it could explode for the moving average. Doesn't mean the price doesn't stop from going up, because if the moving average goes up, guys, the price could still go up. But once you're in this outlier territory, you're not at, low risk entries. The low risk entries is when you're coiled and tied to a moving average, like back here.
Now, Pat, what's interesting is that the two times that it was substantially higher than that dotted line was in the 70s. And that was the era that many are comparing this very time frame to, from a macro perspective, in terms of stagflation, debts, printing, etc. And if that's the case, if this decade is what resembles the 70s, then it's possible we might see a similar kind of a move.
That's right. So this is how you do it. The 70s, you have let's say a rising trend line, distance from moving average, the energy, the explosion of the price chart away from that longer term moving average never really faltered below a rising support line. So it went up, exploded, went crazy. And that's great. Here it did it the first shot. Here, look at that. It did it second. Before it imploded, it was
the recession. We went into recession around 72, 73, and that you see that huge drop right there.
If I move today, if people are expecting like the 1970s, then this line has to hold and it has to accelerate upwards.
Yeah.
So you don't want this to fall. If this falls, that means the momentum is slowed down enough that you're entering a more important correction, because the low risk entries here is like here, down here, back in 2023, late 2023, or here back in June of 2019. Those are the low risk entries. When you're up here, you're entering froth. It doesn't mean it can't go up, because you're 100% in an uptrend, guys. 100% in an uptrend. You're above a 12-month moving average. Everything's fine. So stackers don't care about price. So I should not even mention them. But long-term investors of gold, those that bought at these low risk entry points, or bought anytime like when the price was not coiled and stretched, you're fine. You're riding the uptrend. But if somebody's on the sideline, it's not optimal right now. I have a shorter term chart, which I've been drawing to help people there. If gold, probably get interested right here as a continuation. If you get a close above right there, such a beautiful 1, 2, 3. I would say a close above 34, 34.50. Then I get interested again. then that consolidation we've been going through for the past 4 months, it ends, and then we get a move up there. I think I put on Twitter, I had the
So Pat, if you look at the gold chart here since the breakout last March, there's 2 or 3 or 4 periods of consolidation as gold is moving up in trend, right? Since the breakout. So it moves up, it consolidates, it moves up, it consolidates, et cetera. Are you expecting that trend to continue once it breaks out of this consolidation time frame?
So if it breaks out, I have a target at 3,800. That would be the next, and that's a conservative type of time frame. It's the measured move from this basing pattern here, this consolidation, this flag added on top. So for me, that would be the next target, immediate target. Once we close above 3,450, then after that, that'd be the closer by target. But I'm always a little skittish because this correction and consolidation is happening. I'm going to put back on the monthly chart. There's a chart because it's happening because we're stretcher from that longer term moving average. There's headwinds. There's headwinds here at this moment. So while we might have a little burst and go up a little bit more, sure, price of gold is going to stretch a little bit more. That's fine. But I'm still skittish because that's where you find important corrections there. You'll see here, look, once I was stretched that much and the price started losing a rising support line on the momentum indicator, price of gold went sideways for like a year. Here's the GFC one, it went up super stretched, and then the price went sideways for a year after it lost rising support line. And on the third shot that it was that stretch, well, that was the end, right? It went sideways. Greece bank issues. Remember that? It was crazy back in 2011. Like it was the most fundamentally, I don't know, gold should have went whatever to the moon. But what happened is because it was stretched for so long, it ran its course. The stock market, the growth stocks were starting to break out versus gold. It's just the end, it was just the end of that run. So because after an initial breakout, you don't get many shots there. You get one shot, a continuation pattern 1 time, 2 times, 3 times. You get 3 maybe of those. So you kind of get too greedy thinking that this thing, of course, unless the US dollar goes like the Turkish lira there, then of course that's what everybody imagines, right?
So what's your upside target here over, how long of a bull market are you expecting, and what's your upside target?
A long one. It's going to be long.
Okay. So because just a moment ago, the picture you were painting made me feel like, this isn't going to be a very long bull market, but you're expecting this, even though there'll be dips and falls back to the 200-day moving average and other issues that'll take place. You're expecting a long-term bull market within gold.
Yeah. Look, I'm just drawing this one as an example. I don't know if it's going to do that, but you got to always draw and imagine. Look, as long as the price of gold stays above the 3-year moving average or that longer term moving average, it's fine. It's still in the bull market, even if it goes sideways for a year and a half there. I don't know if it's going to do that, but imagine, I don't know, we have another GFC type of recession and it drags the price down. It's gonna people are going to liquidate their gold to whatever to cover their margin calls, whatever is going to happen. This is still a bull market. My goodness, for me to start getting skittish on gold, or even here I started saying, I wasn't very happy. I had some bearish scenarios back here, but it recuperated. There's no bear market until it's the bull market. You don't flip from a bull market to a bear market. You flip from a bull market to a topping pattern where the bull market's ending. Then after that, after a little while, then it turns down. Then you have a bear market. Then it bottoms. Then after that, okay, the bear market's not really there anymore because the price is going sideways. But then the bull market, it didn't start here, the bull market, it started here, right? So right now, this is a highly likely scenario. Why would people be surprised that this happens? That was exactly what happened in the GFC right here. And even before the GFC, look at that, Gary. It happened here also. That, like, I just drew that. So why would you expect this not happening again? It could, people getting greedy. People get greedy. They're there and they think it's a moonshot. I would love to see this, because this, what it tells me, as soon as that happens, that means here the distance from the moving average is going to reset. And guess
That's a
what?
higher risk, lower risk entry point. Is what
Ah, goodness. If that happens again, load up the boat.
yeah.
Load up the boat. There, down
Okay.
here.
So
Load up
what
the boat.
is your
Not financial advice, guys.
is your timeline stretched into the 2030s? And where's your upside for gold?
I think the countdown to the start of the bull era, for me, it's using the gold versus SPX chart. I got to show you this one again. It's this one here. This, I think no matter where the price of gold is when this breaks out, I think we got 10 years added to whatever the price of gold is once this breaks out. Once gold breaks out versus SPX, I would add 10 years on top of that. That's crazy. So whatever it's doing now, for me, it's embryonic. It's a bonus time, whatever's happening now to price gold. So it's in a bull market, right? But for me, it's not going to end until it extenuates until it runs so hot, so bright that it's killing the SPX for many, many, many years. And once it burns itself out like a bright candle against the SPX, and the SPX starts, recovering from multiple severe bear markets like this, then it's over.
Okay.
Even stackers could think about switching to the SPX. I know they won't do it, but long-term investors. So the bull market.
That could be mid 2030s to late 2030s, because gold is not yet destroying the SPX.
No. Yeah. It's just going sideways.
Yeah. Okay. Now, what about your expectation? What's the charts telling you about where you think gold is actually going? Is it going to 5,000? Is it going to 10,000? Is it going higher than that?
Gold is 100% going much higher. At the beginning, I know we're far there, but five-digit gold there it's almost inevitable. The longer this takes to break out, the longer the look at that. I got to show you this. Let's say the ratio. Let's say gold. How could I say it? I'll go on the. I'll show you guys this there. Yeah, I'll do the XAU USD / SPX. Okay, so let's say this is the ratio of gold to SPX. Or should I do SPX to gold, which would be easier? I'll do SPX to gold. I'm not sure anymore. Which one's the better? XAU USD. Okay, maybe that's going to be, no, I'll do it the other way. Okay, so here, let's say we get back to 2011 top, just the 2011. I'm not getting greedy. We're going to, oh no, that's not 2011, reset chart. Okay, let's do it this way. Let's say we go back here all the way to a ratio of 1.5. I'm not even doing let's say we're 1970s, it was an off thing. Let's 1.5. If gold, what's the SPX right now doing? SPX is at 6,400. Gold usually tops when the SPX completes its bear market. So if the SPX starts going to a bear market at 6,400, 6,300, it goes down, whatever, let's say 4,000. It goes back up to 6,400, then goes back down, then goes back up to 6,400. Once SPX breaks out above its 6,400 level in 10 years, that's when gold tops. People think gold tops when the SPX bottoms. No, gold tops when the SPX breaks out of the top, out of a long-term pattern. So let's say my ratio is here 1.5. So gold's going to be worth at least 1.5, whatever the price of the SPX is once it starts rolling over. So what's 1.5 times 6,400? Yeah, we're at over 10K there.
Yeah. Okay. Well,
so
good.
That's right. Some math, some racial math there.
Yeah. I appreciate that puts it in perspective. Okay.
Yeah,
let's move over to silver. Let's have a look at the silver map.
And people should not be impressed by 10,000 gold. It used to be 25 or 40. It's like life still goes on. It's just they're destroying your fiat.
Yeah,
that's what you're seeing there. Your purchasing power, they're just putting it down the drain there. People should get upset at that, actually, but We're like the frogs in the boiling water. We never jump. You have like, it depends. If we have 10,000 overnight, people are going to jump. But 10,000 in 10 years, I don't think people are going to go crazy over that.
Yeah, okay, I would agree.
Silver, I have to show you the silver chart, the yearly chart for silver. It is just crazy what we might be living through. This is the silver chart yearly, and we could have, that's the 1980s top here, 79.80. See, on the line close basis, if you forget the peaks, people, they say, silver's not above its 1980 peak, not above its 2011, but who cares about peaks? Those are clickbait headline news. It didn't stay there long. It's not that meaningful. But if you put it on a yearly chart, remove all that noise, what price did silver close the year? That's more meaningful. You reduce, it stayed what, a couple of weeks above 30 back in the 2000s. It stayed what, it's a few days above 30 in the 80s. Who cares about that froth? It distorts the reality. But look at this.
I think the one thing that people probably do care about is the inflation adjusted price. It's, if you compare the inflation adjusted price of today versus 1980 or even 2011, because of the purchasing power degradation of the dollar, we're so far below both of those pivot points.
Well, that's the problem with silver. Silver does not track the CPI price. It tracks the gold adjusted for CPI. For some reason, that's the chart where here I have hold on, let me just put that on the log scale. Is that the log scale? Yeah, okay, they're both on log scale. What I just added here on top is this line here, guys. This is gold adjusted for CPI. That's a gold adjusted. And look at that when I overlay it. Look at that.
That's amazing.
Here before it was pegged there. So for me, that's the closest chart, the macro chart. So it could start giving people clues. Oh, look, silver tracks the inflation adjusted version of gold. Ask ChatGPT to make sense of that. Maybe it's going to create some nice narratives to explain why that happens. So whenever people say manipulation, silver, blah, 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 I say, guys, look, at the end of the day, it's tracking gold's performance versus inflation. Whatever gold is able to do to outperform inflation, silver is like a derivative of that. And that's the play. That's what it does. That's how the market's pricing it in. I could have any reason why it should not be like that. I could think it should be more, but at the end of the day, look at the chart. It's the same. Am I doing a mistake? No, it's the same chart. But this is the beauty of it. Gold versus inflation. Look at that. It broke out. Look at that. Oh my goodness. It broke out last year. Confirmed breakout. It's done, Gary. It's done. Confirmed breakout last year. Silver always follows. Great news. And silver is probably going to break out here this year. If it closes even at 38, it doesn't even have to go up silver much. It's probably going to go higher maybe by the end of the year if there's no massive rug pull. It's going to confirm a yearly defined breakout. I cannot put more emphasis on that, but because in somebody's lifetime, how many times do you see a 50-year cup and handle breakout? It's unheard of.
Yeah.
You're never going to see that again unless you're an elf there or a vampire. You're never going to see that.
Well, it's very exciting for all of us who have been in the metals for quite some time.
Oh my goodness. It's payback. This is pay dirt.
So so where are you expecting silver to go? And are you expecting the silver bull run to be as long as the gold bull run?
Yes.
Longer?
Yes. Same thing. They'll end at the same time. They'll end when they fizzle out versus the SPX. I could show you the silver versus SPX chart. It's barely got going. Here's my first target. Non-greedy target is like 66. That could happen really fast. And after that, you get a bigger, get some more greedy targets there. My goodness. It's like, then you triple digit silver, like that. Put that on the title of this video. Get thousands of views just for the crazy target. I don't even want to say it out loud. People used to get mad at me, but it's going to happen, guys. It's going to happen.
Pat, if you know me, I'm not a clickbait kind of a host. So,
well, look, guys, viewing this video, it will happen eventually. I can't say 100% certitude, so I shouldn't say will because I'm conflicting. I'll say that there's a very high probability that 5-digit gold and 3-digit silver, they're in the cards, because I'm telling you, look, they're in uptrends. What do you want me to tell you? I'm not going to be bearish until that uptrend is broken. Why would I do that? It's higher lows, higher highs. Forget about it. That's what it is. So,
okay, wonderful. I think loud and clear we got it.
okay.
All right, we're gonna skip a few of the things we talked about earlier. We're gonna move over to oil.
Yes.
Okay. Yeah. So Pat, oil has been range bound about $60 to $75 for several years. Oil prices have a big impact on the profitability of the miners, which we're going to talk about next. Would you pull up the oil chart, show us what we're looking at here and what you're expecting for oil?
Oil, it's having a hard time. It's pricing in whatever, possibly a recession that's going to happen, the unemployment rate going up. It's on life support, oil. It's 100% on life support. That's the quarterly chart for oil. It hasn't broken out yet. It had some levels here at my goodness.
If it does break out, are you expecting a breakout to the downside or higher?
Well, it could always vomit like it did back here in the 2000s before the crazy launch. It did a nice vomit here on the turn. So when we had that 2000 recession, oil vomited, and once the markets recuperated and everything started turning back up, then you had a crazy run. So, coppers have had a hard time. It had a hard pullback. It had a false breakout. It's possible this thing breaks down some more there. It's possible. So I can't. Okay. It's getting cold and tight.
Are you expecting it to stay at the very least, at the bare minimum, range bound, 60 to 75, upper 70s?
Yeah, that could happen. If it breaks down, I don't think it's going to be for maybe a very long time there. We might have some crazy a vomit in the, my goodness, look at that thing. Maybe we've had it already, the vomit there. But it's having a little hard time there. So above, what I could tell you is above 58, fine. I could go sideways, but it's still below declining moving averages. So it's not optimal. If it goes, I'd have to get bullish back oil there if it could climb back above 78, 75, But there's some great charts like Shell Oil there. Like, look at that. Like, there's some charts there. Look at that there. Shell Oil, man. That thing is getting
it looks like it's at its highest. Yeah. Is it starting to roll over?
No, I think it's probably wait, I'm going to put Shell price in American dollars there. There's a crazy breakout. Here's Shell. There's some crazy charts out there that haven't broken out yet, but Shell could be breaking out soon there in the US dollars there. 1, 2, 3. It hasn't done it yet. It's a mixed bag until you get these confirmed breakouts. These lines there, it's hard to expect it to do something before it happens. Often that's the chart trader. What he does is he's the guy on the sidelines. Once you identify there's a pattern, a possible pattern, because a pattern's only a pattern once it's confirmed. So if I have a pattern, the price is ranging in it. Okay, fine. I've identified that. So my job is just to wait and just wait until one breaks out. Because sometimes people, they want to know, what do you think? Where's it going to go, Pat? And then we give odds. I think it might go 80% up, 20% down. And they act on that before the breakout. Don't do it. You're throwing away all the advantages of using technical analysis. If you're looking for bullish looking patterns and trying to anticipate a breakout, you're asking for, you wait until the breakout happens. And then you go long. So like oil sideways, maybe it could vomit if ever there's a puke in the, sorry about these words there, about if the price goes down, US equities could get dragged down. But I expect the long-term oil price to go much, much higher, like $300, no problem. I know people, they say, I can't have $300. If you have $10,000 gold, guys, and $100 silver, 100% you could have $300 oil. I don't see why. And that brings me, I don't know. Did you want to talk about the miners next? Because there's some, you see, look, $300 oil is in the cards there eventually.
Okay. Yeah, it's just so, but maybe that would come after. So if you're predicting a stock market sideways crash, and SPX going nowhere for a decade, and you believe that's coming soon, why would oil go to $300 while the SPX is going nowhere or down?
Well, on the recoveries, so it'll go crazy. Here you see the stock market. I'll put my recession indicator right there. Oh man, I have to fix that thing there. Background. Let's put it dark.
Coming out of the .com, it did that.
And GFC. So look, you see here you see the .com brings oil down, but after that, on the recovery side, oil SPX goes up, the Russell goes up, silver, everything goes up on the recovery side.
However, we haven't had a recession or a stock market drop. So
not yet. So we have to wait. So maybe we will get a vomit here, and then after that, off it goes on the recovery side here. Here's the GFC, and look.
It looks like over at least the last three times, including after the pandemic, it happens after coming out of the recession, not before the recession.
Oh, exactly. It rockets upwards halfway through in the abyss. Silver actually also bottoms in the middle of the abyss of a recession. It could actually shoot up. See, shot up in the recession, oil here. Shot up in the recession, then got dragged down. So we could be entering a recession. Oil keeps going up. Then after that, oil gets dragged down when everybody starts liquidating everything.
So do you have a high probability conviction here? Does oil stay in the current range bound for a period of time until a recession or a drop in the SPX? Do you see it going higher into a recession, or do you think it only goes higher coming out of a recession and SPX drop? Do you have a high conviction call on that, or no? You don't?
No, I don't. I just don't, because of the nature of the pattern here. It's it's
not telling you enough.
It's too coiled, too trapped. These are quarterly candles. It's
okay.
too
fair enough.
I'm sorry, guys. I can't we'll have to see. We'll see how it behaves sometimes, because often that's it. People they look for, it behaved like that previous time. It will behave this time. But if I go back in the 70s, there's periods where there were recessions and oil did not give a hoot about recessions. Look at that. Like, there's moments here. You see, it shoots up in a recession, goes down. So we'll have to wait and see. But what I do know, what my high conviction is, Gary, is that after all that, as soon as the markets start recovering, after the next important bear market where the markets go down 30, 40, 50%, my high conviction is oil will rocket upwards.
Okay. Yeah, I hear that. Yeah, I hear that. And I do believe, based on what we're looking at in this chart, that is definitely supported by what we're seeing. All right. So you recently launched MinerCast. And, the reason why I wanted to talk about oil before the miners is because oil is such an important part in miners' profitability. But why have you launched MinerCast now? Like, why now? What is it? How is it helping the investor community?
Yes. So on our website there, we have a whole series of podcasts where we cover, we have a market roundup, cover markets, economic, macro. We have a crypto cast, sometimes a uranium cast, depending if the uranium stocks are hot. So now we have the MinerCast, which we do when either people had entered mining positions and now the mining positions are starting to mature and they want to see, maybe is it time to take some profits, or if there's some new developments, the miners are starting to break out versus SPX. So the MinerCast is a podcast where we just focus going through charts related to the precious metals, but more like specific miners. And we tell you how it is, like what's happening. Here I have, like, let's say Wheaton, like, okay, a lot of people are in Wheaton. What's happening with Wheaton, Pat? Is it time for me to enter? Is it time for me to take profits? And we just go through the charts like that, and we review them and tell people, well, look, you've reached a measured move. Even, oh my goodness, even see there's some very good miners that are, look at that Wheaton. Yeah, it's getting to that zone there where maybe it's getting really close to taking profits there, Wheaton there. That's a monthly chart. Yeah, I don't know where to put that line there. But that's the value we bring there for.
Okay, so outside of this particular one, what's your position on the miners right now? Are they in a bull market that's going to? I mean, they're clearly in a bull market. They're up like 60, 70%. The GDX, GDXJ. since the beginning of the year. What's your projection for, what are the charts saying for how long this is going to last?
Well, I'll show you this chart. This is the unemployment rate, and I'll overlay the ASA chart. ASA, guys, please use it. ASA is the gold and silver miners ETF or fund that dates back all the way to the 1960s. So it's very old. It gives you a lot of data. The JDX is kind of new, but JDX, Huey, JDXJ, they track pretty much what ASA does. Look at the unemployment rate. My goodness, did I choose the good colors? Let me choose some. I'll choose some. Okay, here. Check this out. The black line, guys, in the background, the bottom one, is the unemployment rate. A macro, and we've talked about this. It's like the business cycle, it's the setup that it's not going too good. The miners, they love economic turmoil. Maybe, again, because of the oil prices going down in recessions, helping with whatever the margins, making the miners better fit. Look at the 70s, higher lows, higher highs for the miners and for unemployment rate. Loved it. Unemployment rate unwinds. Guess what happens to the miners? Unwinds. Look at that, the 2000s. Unemployment rate trends upwards. Get what happened to the miners? They trend upwards. Happened again here back in after here 2010. Miners unwind. Here's even here the COVID spike and unemployment rate. The miners shot up, unwinds. The miners are telling me, and I'll show you. I have to show you one more chart after this. That they're sniffing out that the unemployment rate is going to rocket upwards. The Fed's going to cut the rate cutting cycle, and the miners they smell the problems in the economy as defined by this chart. There, you'll see that this is not good for the economy. The fact that the miners are going up, right? So that's step one. Why the markets, the miners are in a bull market.
So in your estimation, then, based on what we're looking at here and what you've seen in the past, as long as the unemployment rate is remaining where it's at or going higher, then you expect the miners to continue to advance. When they start to come down, when the unemployment rate starts to come down and there's healing being brought to the economy, then you expect the miners to drop.
That's right. And I have a chart you might not want to buy miners after I show you the next chart. I got to show you this. You're spot on with what you said, but I'll bring it a step forward. Yes, it's exactly that. Once there's a real recovery like this, or when the unemployment really unwinds, that's it for the miners nominally, price in fiat.
Well, then how long? I think the question is then how long do you foresee an unemployment issue lasting?
Well, it's going to probably look, if gold breaks out versus SPX and the SPX goes in a few or a couple of bear markets, then yeah, it could be 10 years of just turmoil, like economic turmoil, recoveries, and then rug pulls. It could be a long time. So the miners will get tailwinds for whatever, the next 10 years, they'll get tailwinds priced in fiat. But I have to show you this trick. So fine, they're going up in fiat. There's no problem there. But what about price in gold? Should I be buying gold instead of the miners? And of course, guys, there's a handful of miners like Wheaton, Dundee that outperform the index of them. But if you're just buying the index, this chart might make you a little skirmish here. Here is I'll show you here is the miners priced in gold right here. Okay. Look at this, the 1970s bull era. Well, look historically, the miners have got destroyed by gold. Destroyed. You should have been better holding gold the whole time than playing the miners. The miners here at the beginning of a bull run, they outperformed the metals in the first couple of years. First couple of years, they outperformed the metals. But after that, the metals destroy the miners. Same thing here. Look, in the 2000s, here's the 70s bull run. The miners did great until 2002, 2003. But after that, they were on par. And then they got the rug pull and they closed the show in 2011 lower than all those peaks. So you got to say, whoa, hold on. Yes, they are going up in nominal terms, but it could go back to your point, Gary. So guess what's happening to the oil prices after 2001, 2, 3? It goes up, right? It probably stifles, like, I don't know, I don't want to fit narrative, but the rising oil prices, they probably stifle the value of the miners versus the metal, which the metal doesn't care about oil. Here's versus silver, same thing. The miners do great at the beginning, but after that, the miners lost 87% of their value from 74 maybe all the way to 1980s. Same thing here. They did great, the miners, but since 2003 or 4, they lost 76% of their value priced in silver. But look at this. This is critical. Here is the miners versus silver. The unemployment rate, the first peak there after the onset of the bull era, the bull market, I should have drawn a vertical line. The miners peak exactly after the first unwind of the unemployment rate. So as soon as we get that first jolt of unemployment rate after the bear market of the first bear market of the US stocks, as soon as the market starts sensing, recovery time, we're having a healthy, the first healthy unwind recovery. Look at the miners. That's it. Versus silver, normally on their own chart, they're going to keep going up. But
it sounds to me like you're saying that the exit point from the miners is when inflation after a rise, when unemployment after a rise starts to actually come back down.
Yes.
Once you start to see 1 or 2 or 3 unemployment numbers in a row coming down after a period of rising, that is your indicator to probably get out of the miners.
Yeah, you'll see it on the charts. Like, let's say you didn't know about this relationship there. You could just look at the miners' price in silver. I could have drawn a beautiful rising support line. If it falls below that, then I know the miners have lost their upwards momentum versus silver, and I could consider maybe selling half of my miners and starting to load up on silver a little bit more. And if the trend starts to worsen in favor of silver, then I would drop more and more of my miners and just swap into silver. You don't have to go binary. But it's telling you that the miners, they top out. You see, even here, we had the second wave of unemployment rate, and we know that the miners kept going up, right? Remember that previous chart? But on that second wave here, the miners just didn't perform. They didn't perform. So it's 31 months here, 25 months here. So I'm expecting that. Of course, always look at the charts. It doesn't have to play like that again there. But the miners, they have a short lifespan of them being the stars of the show, right? Then after that, it becomes silver, because silver outperforms gold. Silver outperforms practically everything during a bull market. Even silver measured against, there's practically nothing that outperforms in the major asset classes that outperforms silver. Once silver gets its groove, when the GSR starts breaking down, the gold versus silver ratio breaks down. Silver is the money play there, and it's less hassle, less risk, less everything, because there's no CEO that could run away with his girlfriend. There's no Bre-X moment. There's nothing. There's no problem with silver. Like, I know people, JP Morgan, but JP Morgan will be covering their shorts and going long, fueling the silver run once it starts outperforming everything. Because if it's outperforming everything, they're going to have to cover their shorts, and they'll want to go long because they'll want to ride that gravy train, right?
Yeah.
That's my rant on that.
Well, I think that was really interesting, and it gives the mining investing community something to ponder here as to when do I actually exit my positions. Those unique relationships are interesting, so I appreciate you sharing that. This has been an incredible discussion. I just want to welcome everyone who's tuning in to this fantastic interview with Patrick Karim, co-founder of Northstar Badcharts, a leading technical analysis and charting firm. Before we wrap up with Pat, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. I'm also positive you've been enjoying this discussion that Pat and I have been having. Please let him know. Hit the like and subscribe button and leave a comment below the video. Pat, just to wrap up here, would you share a key takeaway that you want the viewers to keep in mind? It could be about today's economy, the markets, the monetary situation, or even something in the charts, and then let everybody know where they can learn more about your work and how they can connect with you directly.
Well, guys, look, we're so early. These ratio charts there of gold versus SPX, silver versus SPX, platinum versus SPX, miners versus SPX. We're so early in this precious metals bull era. And bull era for me, guys, a bull market is when you go up in price and fiat, and they're the miners are doing that, silver, gold, like they're all in bull markets, but the bull era is when you're supercharged and you're going up in fiat, but you're also going up priced in your competitive asset class, which is the stock market, right? And once you get that hedge fund money and that pension fund money rolling into your sector, that's when your drawdowns are less and you go up faster and longer in the shortest amount of time. That's when it's going to happen. And that period has not even started yet. So wrap your brain around that. Whatever's happening now, small potatoes compared to what's going to happen later on. That's my my takeaway. And until the charts prove me otherwise, I don't see why we should think otherwise. And of course, everybody follow me, Badcharts1 on Twitter or X. We have a website with Kevin Wadsworth on the Northstar Badcharts.com. And maybe for your viewers, I could throw in a discount code if they want 50% off. I don't know if you mind if I share that.
No.
Use a summer25. You could use that discount code and get 50% off a lifetime. And yeah, you get the MinerCast and all that other great stuff there.
Okay. Well, that's awesome. Thanks, Pat. You and I didn't discuss that earlier. So I'm going to put all that information up on the screen. It'll also be in the description area for everybody to click through. Go over to, first of all, go to his X account and follow him. And he shares a lot of these charts and a lot of information. He answers a lot of questions with the community, but also head over to the website, take a look at their offering, take a look at what they have. It'll be worth your time. Pat, thank you for coming on to Metals and Miners again, for being so generous with your time and analysis and ideas. Always love connecting with you. This time is no different. And I look forward to having you back on sometime soon. Everybody else, thank you for watching. Before we wrap up with Pat, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.